So, Daleep, as we talk about just how worried everyone should be about the debt ceiling crisis, this is something many large-scale investors have shrugged off. How big of a deal is this?
Well, Dom, Kelly, when you talk about default, it's a dark and needless journey into the unknown. No one has any basis to make confident predictions because it's never happened before. But it's safe to assume the uncertainty alone would crush equities and crush credit markets. Unless the Fed steps in to quarantine the market from defaulted securities, there could be major disruptions to the plumbing of the global financial system that liquefies the global economy. But even if the Fed intervenes, this could be seen as subverting the will of Congress and putting at risk the independence that it considers to be sacrosanct. So look, what happens to our borrowing costs and the dollar in that scenario when 7 of our $31 trillion of debt is held abroad? That's anybody's guess, but this is a reckless, unforced error that we should never make.
Now, Daleep, if you take a look at the way things are shaping up right now, the reason why many large investors are not as scared, simply because we've never done it before, and every time we've come close with the brinksmanship game, we've found a solution. What exactly then do clients have to worry about from your side of things with regard to what would eventually happen? Is there a bad case scenario that you're trying to kind of plan around contingency-wise?
Yeah, I mean, you have to think about worst case scenarios all the time if you're managing risk. And look, it seems as though the best we can hope for in the very short term is a signal that we're headed for a short-term punt. But that's not a given. Even a short-term deal has a price, and it sets a precedent. In this case, what would be the price of gaining a few extra months to negotiate? Maybe it's rescinding the unspent COVID funds, but it's also the harmful precedent of horse trading U.S. default risk when it really should be non-negotiable and totally off the table. And what's the return, Dom? Does anything really change even if we get a short-term deal? The budget choices and the constraints, they're the same. 4 months from now, we'll just be closer to another general election that makes it even harder to come together.
Major investors, Daleep, have been in that 1 month Treasury bill. Berkshire, I think Bill Gross, others saying, I'll take 5% for a month or whatever that is divided by 12. Anyway, it's a lot if you've got several billion. And again, the opportunity wouldn't be there if we weren't talking about a possible default. What do you think about the rest of the curve at this point? You know, anybody, even if you're in a 1 month bill, OK, so you get your money back in a month, you got to do something with it. You're in 3 month, you're in 6 month, you like that 5%, but you can't get it if you go further out on the curve. What should you do then if you're looking for a return where you want to have your money locked up or safe for maybe a couple of years' time?
Well, look, in my view, conditions in the market have to get worse before they can get better. So if you're thinking about risky assets, equities, and credit markets, I can see a lot of downside from here. When it comes to short-term bills and risk-free assets out the curve, you know, there's going to be a sizable economic effect if we go anywhere near the X date and beyond. And so normally you would expect those yields to fall and you can get some return, especially when the risk premium being built in is as high as you're describing. But again, this is a venture into the unknown. We simply don't know, especially in the geopolitical context in which we're having this discussion. We simply don't know what the knock-on effects of a hit to confidence of this size could do to assets that we normally think of as risk-free.